Hello everyone. Now we are ready to start the webinar. I hope that you hear me well, and let's check the sound. I remind you that we have two chats here. One is general chat and the second is questions. So if you hear me, please let me know. Please let me know using chat. Any type of the chat you like. 1, 2, 3, 4, 5, 6, 7. We are checking the sound. I hope that you see the slide that is Trader's Edge and hear my voice. No. I don't mean chart. You have to see the slide of a presentation. No charts yet. I'm not showing you any charts for the present moment. Yes, you can see the slide and you can hear my voice. Okay, I think we can start with that. All right. Now, I welcome all traders today, and my name is Stanislav Bernuhov. I'm a trader with more than 11 years of experience for the present moment, and I will share with you some interesting ideas and interesting information concerning trading. If you have any lags with sound, if you have any technical issues, just let me know in the chat. You have questions chat and general chat, so I will know that it needs to be fixed. But I hope that everything will be okay. Alright, let's get started. Our today's webinar is called The Trader's Edge, or How to Survive and Succeed in a Trading Marathon. I know that this topic is pretty much common. Because what is a trader's edge? For some traders, trader's edge is analytical context, knowing analysis. For other traders, it is execution, it is knowing price action, ability to read charts. And for other traders, it is maybe knowing indicators or some other kind of tools or instruments. We will try to think or to talk about this topic from the bottom up. We will talk about discipline, we will talk about analytical context, we will talk about market conditions, and we will talk about overall mathematics beyond your trading that you have to keep in mind to be able to be successful in the long run. Alright, the small disclaimer before we start, it is traditional one. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial and you will have full responsibility for any of your trading decisions, so please trade responsibly, test any of ideas you think about, and remember that past performance is not a guarantee of future returns. Alright, let's get started with the thought or with the idea that many traders start with in their trading, especially beginner traders. They try to take someone else's trading system, trading strategy, whatever they take it from. It can be trading forum, the book, or a friend, and they try to implement this strategy in their own trading. Well, it might be useful for beginner traders to trade using someone else's strategy for learning purposes. However, the majority of professional traders use their own strategy or their own edge, if I rephrase this word, strategy, or even their own variation of someone else's strategy, because we don't need to invent indicators, we don't need to invent any analytical approaches. We can use common indicators, we can use common approaches, but we do something that we are best with, so it is our own variation of someone else's strategy. So it is very difficult to borrow your edge. Traders with enough experience, they know it, because I was using many strategies, many common strategies in early days of my trading career. I was employing indicators, moving averages, MACDs, stochastics, and other things that I thought would help me to earn any money. But in fact, I've come to the price action, to reading charts. I've come to I've come to importance of understanding the market, because it is very difficult really to understand the market, to understand what is going on, what is happening beyond the price movement. But there were no other way for me, because I wanted really to figure out what is happening in the marketplace, and to have my trades, or to do conscious trades without just picking bottoms, picking tops, without just buying and selling because any arrows they push me to buy or to sell. Okay, now I want first, before we proceed, I want to distinguish mechanical edges versus discretionary edges. Some traders think that, okay, all I need is discipline, because if I had enough discipline I would earn money consistently. And if it was so, if following your plan was enough for earning enough money, we would have seen much more successful automated trading systems, successful robots. And in reality, if you stick to a plan that is not good, you will also not earn any money. You might earn modest money, or you might not lose your capital, but in fact, if you just follow any mechanical trading strategy or system that that is not very smart, you are going to, not maybe to lose your money, but you are going just to break even. I have seen many mechanical trading systems that are not earning money in the long run. Though traders think that decision making in mechanical trading is easier, so they try to do that. They treat it as an easier decision making process. Because they have rule-based entries and exits, they backtest, they evaluate, they have formalized entries, formalized exits, so it seems to them more easy. But in fact, there are several drawbacks in using mechanical edges. First of all, it is unstable performance, because you have to adapt to changing market conditions, and more often than not, when market conditions change, traders often have to redesign their trading strategies. As for discretionary trading, we have much conflicting information. You never know what to do. Do you need to buy or to sell? What trend are you going to go with? Are you going to go with the ascending trend or a descending trend? You never know. And you have much conflicting information, because you have to make decisions all the time, and it might be not very easy. Also, it is harder to backtest or evaluate your trading when you use discretionary trading approach, because your entries and exits may be not formalized 100%, and you just can't take and backtest your strategy. But of course you have some flexibility, and you can put your entries and exit in an analytical context. So it is positive sides of discretionary approach to trading. As for me, I am follower of discretionary approach to trading. I would say that mechanical approach is not very easy, because you need to be possibly a good software developer. You need always to test and test again. It needs to be done on a consistent basis. As for discretionary trader, I can be either analyst, I can be a trader, and I can be a risk manager. So I don't need to test and test 100 times. So I can take just one strategy and stick to it. Okay, let's move on. Just a minute. Okay, I would say that if you need to know the foundation for a good trade or for a good trading, I would say that first of all you have to do analytical studies, whatever it means. By analytical studies, I mean identifying market condition, because you may have good entry point, you may have good exit point, you may have trailing stop or any of this kind, but it will not help you earn money in the long run if you don't have analytical context, if you don't know market condition. too many times traders stick too much to entry points. They try to optimize their entries, optimize their exits, and they try to know whether it will be good to buy or on a pullback or on a breakout, use 2 or 3 candlesticks or bars, or just 1 candlestick or bar beyond this level to make a buy, to make a purchase. It is tactical response. I would call it tactical response. It is entry, exit, and position management. But if you don't put your entries in analytical context, your results will be unstable. Your results might be unstable, and they will be unstable if you don't apply any top-down analysis to your trading. And also, money and risk management is the third thing in a foundation of a good trading. All right, guys. I will offer you a small test. Let's entertain this webinar. I will give you a small test. I want to know your opinion. What would you choose if I offer you 2 boxes, 2 black boxes? Okay. If you pick the white ball from the first box, I will pay you $300. But if you pick the yellow ball, I will not pay you anything. Okay. If you take the second box, you will get $200 without any risk. So please let me know in chat, what would you choose? It's important because it concerns psychology of trading and trading thinking. Alright, you will pick the second choice. Okay, $200. What else, guys? So who else would pick $200? Well, it seems rational. Second, okay. I need more answers, guys. Please be active. Let us make this test. $200. Oh, I understand if you need money. Of course, if you need money right now to cover your costs of living, of course you would possibly make the second choice. All right. Who else? Who else would? Maybe someone would pick the first choice, $300 with probability of getting nothing. Well, no one. Okay, no one will actually accept the first choice. But let's think about trading. In trading, there are no guaranteed results. Okay, so you don't have a black box with guaranteed $200. In trading, you have several outcomes. You can either get profit, you can either get loss, and also you can play a break even. Okay, so in trading you can lose your money, you can earn some, and you can be robust or not lose anything. So in trading there is no guaranteed result. In trading you have to accept risk. And most people, they come to trading and they try to make the second choice, or at least what they think is the second choice. They think that there are choices that will allow them to take profit with 100% probability, or even with 90% probability. So they try to gravitate to opportunities with 80 or 90% of success, or they search for such opportunities with 80 or 90% of success. But if you talk about trading, I don't know, guys, whether you are familiar with the concept of expected value or not. Let's go to the next slide. Expected value is a sum of variables. We have the formula listed here on this slide. It measures the expected value of your trade. Expected value can be both positive or negative. So to be able to earn money in the long run, you need to have your expected value to be positive. Okay. So in the first case, you have. Let's try to draw. You have 25% of probability of getting loss, of getting nothing. Okay, 25% probability of getting nothing, and you have 75% probability of getting $300. So If you multiply the payout of $300 to the probability of this payout, which is 75%, you will get $225. That's your expected value, right? That's your expected value, $225. In the second case, the payout is fixed, it is $200. So in the first case, the expected value is greater than in the second case, okay? So if we apply this model to trading, we have to make the first choice. We have to make the first choice. Sorry guys, I will be right back. I hope that you hear me. So you have to make the first choice if you are involved in trading, if you are involved in taking risk. 1, 2, 3, 4, 5, 6, 7, I guess that you hear me. Alright, that is a concept of expected value. But let's think about expected value in more broad perspective, in perspective of your trading. We have two parameters that we can influence on. The first is frequency and the second is magnitude. Most of traders, they try to have frequency on their side. They try to take 80% of outcomes. They want to have 80% of positive outcomes. So if you take 100 trade, you want to have 80 trades out of this distribution closing in a profit. And you are okay with having 20 trades of 100 trades closing in a loss. I would say that frequency is on your side. And the second is magnitude. And it is widely known that you can earn money even if you have no more than 20% of winning trades, which means that your magnitude is pretty good. So you have 5-to-1 profit-loss ratio or 10-to-1 profit-loss ratio. It is relative influence of this event on the final distribution of results. I would say, for example, if you have stop loss equal to 10 pips and a take profit equal to 100 pips, you have 10-to-1 profit-loss ratio. So you have pretty big magnitude for your trades. So you have to find balance between these two parameters, between frequency and magnitude. If you achieve 50% of frequency for your winning trades and 3-to-1 profit-loss ratio for your winning trades, I would say that your trading will be very good and very robust. You will earn money in the long run. Also, if you achieve 30% of winning trades with a magnitude or with a profit-loss ratio equal, let's say, to 7-to-1 profit-loss ratio, which is achievable in day trading and in aggressive day trading and in swing trading, I would say that your trading also will be profitable. But if you have 30% of winning trades and if you will have, let's say, 4-to-1 profit-loss ratio, you will also make money. And how do you think? What is better to have on your side, frequency or magnitude? Give me your answer please in chat. What do you prefer to have on your side in trading? Would you like to have, let's say, 70 or 80% of positive outcomes, or do you want to take big moves? I want to know your answer, because it's a very important topic. Okay, big moves, we have one answer. Big moves, okay, who else? Frequency, alright. That's a good thing to have, why not? Some traders, they want to have stability in their trading. Frequency, we have 3 answers for now, and two of them are for frequency and one is for magnitude. Okay, who else? Alright, as for me, if you ask me what would I choose, I would say that I would choose magnitude, and I will explain you why. If you make trading decisions, every time you make trading decisions, you are risking some portion of your capital, right? You're risking some portion of your capital. So you take a risk. Every time you enter a trade, you take a risk. Let's say you want to take 10 trades. You accept 10 trades in a row, so 10 times you take a risk. 10 times you have to decide where to place your stop. And if you need to generate profit, and if you need to have 8 profitable trades out of 10 trades, you will need to put much work. You will have to sit near the monitor, waiting for setups, waiting for really good setups, because you want to have frequency on your side, so your setup should be very good. So you have to be patient, you have to sit near the monitor, wait for your setup, and take a small profit. So it's a bit of work. I would say it is really hard work. Scalping is a really hard work if we talk about scalping, which is a trading style allowing to get the good frequency, right? It is scalping. Scalping is a hard work, really. As for trend following trading, it is much easier way to trade, because you just get inside a trade and you manage your winning position. You let the market to do the rest of the job. You manage your winning position. When the market goes, you go with the market. You don't need to do anything, right? You don't need to search for setups for entry. You don't need to do that. You just move your stop, your trailing stop, letting the market do his job. I would say it is more easy way to trade, and when you are involved in a winning position, you don't need to take a risk and you don't make mistakes. That's why I would choose magnitude. There are greater odds to make mistake in trading rather than just to accept one trade and go and stick to this trade. Well, I would say that there are no such approach that is good or bad. It is just a choice of a trader. Trader has to make a choice. I will choose magnitude, you may choose frequency, but I would say that every trader have to find balance between these two parameters. Okay, how to find balance between frequency and magnitude? Let's go through some tests. When we talk about frequency and magnitude, we have to first learn how to keep above water, or in other words, we have to learn how to cover our cost consistently. That is our first goal as a traders. We have to learn how to keep above water, not to lose our capital in the long run, even if we don't apply any analysis. We need to have mathematics beyond our trading that will lead us at least to survival. That is the first target. That is the first goal. And when I decide what profit loss ratio should I accept in my trades, I do what I call random test. The random test. The goal of a random test is to explore whether your trading method is robust and allows you at least to cover your trading costs in the long run, assuming that you don't understand the market completely. What is a random test? It occurs when you just pick random trades. I would say maybe three times a day or so. Well, it's pretty silly approach, okay, I know, but don't judge it too strictly, because you want to know how your equity curve will possibly look like if your analysis is not very good, if your analysis is random. You have to know how your equity curve will look like. Of course you will apply analysis, of course you will search for some setups, you will try to improve this equity curve. But let's go through such tests. How do I do a random test? Well, it can be either mechanical backtest or simulated trading. I use simulated type of trading. I use software which is called Forex Tester. I trade on historical chart. For example, I use Euro versus American dollar and I trade on historical chart. I use inbuilt functionality of this software to test strategies in a simulated mode on a historical chart. Or you can use mechanical backtest. Let's what do I do in this case? For example, I do the random test for 1 month, for 2 months, for 3 months, and for a period of 6 months or a year. It is out of sample method. It is called out of sample method. Then I compare these several equity curves, and I want to know whether this approach is robust or not. For example, if I take random entry for euro versus American dollar and my stop loss and my take profit are equal to 10 pips, I will get equity curve similar to what you see on this slide. It is 200 trades, and you see that I have series of gains, series of losses. Eventually I earn nothing here, which is understandable because there is no analysis, there are no setups. If I apply any setups to this trading, well, this is scalping, okay? 10 pips profit and 10 pips stop loss is a scalping, or at least very short-term trading. So if I apply any analysis, I can get equity curve looking like I can exclude some sort of some drawdowns from this trade, and I can get my equity curve like you see here, like I have drawn here. So it's pretty robust, okay? So if we switch to another profit loss ratio, for example, if we try to take 30 pips of profit with a stop loss of 10 pips, we will get not so good distribution. Please teach scalping. We have question here. Please teach scalping. Okay, I will accept. I accept your question. Maybe we'll talk about short-term trading and scalping in next webinar. Besides, it is hard work. I must warn you, it is really hard work. It is not very easy, but I can talk about scalping. Why not? Okay, so our equity curve is not so stable like it was in the previous slide. But what happens if we increase our take profit to 70 pips instead of 30 pips? We don't want to take 3-to-1 profit-loss ratio. This time we want to take 7-to-1 profit-loss ratio. What happens this time? Well, you see that we already are having good trades. We are having series of good trades, even if our trades are random. It doesn't mean that the more take profit you have, the more profit you will get. No, it is not that easy, because if you will set 1000 pips as a target, I'm talking about the fourth digit at the right side of the dot, the four digit currency pairs. If you take 1000 pips, well, the probabilities of getting this profit possibly are zero or close to zero. So we have to be adequate in our target setting. 70 pips, okay, it's pretty good take profit for even day trading, because volatility of the market is close to 100 pips a day. So if you enter a good trade, you might take 70 or 80 pips a day. All right. So our equity curve looks more stable. What if we don't use any stop? See what happens? We can earn money in a period of several months. We just don't fix our losing trades. We let the losers run, and we fix only profitable trades. But eventually we pick trades on the wrong side of the market. The trend goes, and we accumulate losing trade. We accumulate the loss, and we can't manage this loss. Remember 2014, it was not previous year, it was a year before the previous year. It was very trending year. Euro versus American dollar was falling, and if you apply this strategy to this market, to this chart, you would possibly lose entire account. So the no stop test shows that it is absolutely unstable. So if you have magnitude on the losing side close to infinite, you will possibly lose your entire account. On the other hand, for trend following traders, it is pretty good approach to position yourself on the right side of the market and just to keep your position. You may have even, I don't know, even 50-to-1 profit-loss ratio or 100-to-1 profit-loss ratio. It is achievable. In January, I have made trade on Canadian dollar. I have bought it in I have bought it in the beginning of the month, and it has generated 500 pips. So I'm more a swing trader, so I'm not a day trader. I hold positions overnight, and it had allowed me to earn 500 pips with a risk of 30 pips. The risk of 30 pips, and you see that possibly more than 10 to 1. It is close to 15 to 1 or so. So it was possibly the best month of the year. It was January. Alright, so if you want to know whether your trading will be robust or not, you have to find balance between frequency and magnitude. I will show you now the statement of one of my accounts. Just give me give me just 1 minute. I will show you one of my statements. And I will show you the example of a trading. Okay, that's it. That is example. I hope that you see my screen. Well, don't mind that you see Russian screenshot or Russian words. See the numbers. Overall month was profitable, but the whole profit was generated during just 4 days within a month. It was possibly 20 days of trading. I believe it was 20 days of trading. You can calculate 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 16 days of trading, and we have 2 winning days, 2 big days, and two average days of profit. Other days were losers. Eventually it was pretty good profit for the whole month, and I had just 2 big moves within a month. So it is magnitude, right? It is magnitude on my side. So I was not going to fix small profits. I was trying to capture a big trade. I was trying to capture a big move. Okay, so you can do the random test and see what happens. You can take, I don't know, you can take 20 pips loss with a 20 pips profit, or you can take 50 pips loss with a 50 pips profit. You can find a balance between these parameters and decide what kind of trader you are going to be. If you're a day trader, possibly you will have stops equal to 15 pips or so, 15-20 pips, because it is average volatility of a trading session. I would not recommend to have very small stops of 5 or I don't know 7 pips, because it is very small. It is very small. So to know whether your trading will survive in the long run, you will need to know what profit loss ratio you have in your trades, and what kind of distribution are you going to see in your trading. All right, now let's talk about analytical context. We paid some attention to frequency and magnitude and expected value of your trades. Now let's talk about trading edge. How can you pick good trades? Well, there are 2 things that are important in trading. The first is a market condition, the second is a price action. Traders focus too much on the price action. They search for specific candlesticks or bar patterns, they search for indicators or whatever things that might help them find a good entry. But very few traders, very small percentage of traders search for market condition, because it is not very easy to identify. We can say that market conditions can be strong trending, rotational, weak, or so. So it is very subjective, right? When you see price action, you see specific candlestick or bar pattern. You see 2 candlesticks or 3 candlesticks. You see some level or something like that. So it is much more objective. That's why traders focus too much on a price action. But we have to combine these 2 things together. First, we have to know market condition, and secondly, we have to know price action. And let's go through basic edges or basic trading ideas that you can employ in your trading. First of all, it is trend following. That is maybe not very easy, but it is more simple than other approaches. You can employ trend following position trading, you can employ breakout momentum trading in the direction of a trend, and you can employ trend following swing trading in the direction of a trend. Three types of actually trading decisions. I would say that if you make any trade in the direction of a trend, you will possibly either trade holding your position, or you will capture quick profit with a breakout momentum strategy, or you will possibly capture profit or capture trade that will possibly be in the market during the 1 or 3 days. It is swing trading. I am basically a swing trader. Also, you can employ counter trend strategies. Traders like counter trend strategies because it's very fast trading style. It allows to capture quick profit. When you trade false breakouts, market breaks out through a level, you're not going with the breakout, you go against the breakout and you capture quick profit when price reverses and gets back to the previous trading range. And also you need to, you increase your odds of success if you fade overbought or oversold market. If you see that the market is overbought or oversold and you place counter trend trades, you increase your odds for success. And someone asked me about scalping. So far, I would say that if you want to scalp, if you want to capture quick profits, you have to master sideways strategy. It is mean reversion, the quick strategy that allows you to capture small comebacks to the average when price gets back from the value and it gets back to the value again. It is mean reversion strategy. You will have possibly 1-to-1 profit loss ratio, and you are going to have 70 or possibly 80% of winning trades if you do everything right. And the second is market neutral strategies or statistical arbitrage. It is not common. It doesn't look like traditional trading with stop losses, because you combine 2 or 3 or maybe 4 currency pairs together, they hedge each other, and you don't have a typical stop loss in the market. It is also an edge, because if you don't have a stop loss, you trade a basket of currencies. Okay, you trade a basket of currencies. It is market neutral type of strategies. Let's go through each type of edge and try to figure out what it's all about. First of all, it is trend following position trading, when you capture a pullback to some kind of level or to some kind of trade location. Later on I will show you examples on a chart, so don't worry, I will show you real examples from chart. When you capture some trade location, for example, you have 2 moving averages crossing, they are not crossing, price crosses fast moving average and enters the area between fast and slow moving average, and in this case you have value area, you buy in this value area and you position yourself in the direction of the trend. The second one is breakout momentum trading, when you go with a breakout, capture quick profit and get out of the market, because market will possibly start to consolidate, or it may reverse, it may come back to your entry point. And the third one occurs when you try to capture more elongated swings. For example, you want to take more elongated breakout of some more wide consolidation area and capture more elongated movement. Let's get to trading terminal. Okay, the good example of such kind of trading is Australian dollar. It was generating the downtrend previous year. It was generating downtrend, and we have seen very good setups to the short side. Very good setups. I'm showing you a weekly chart right now. Let's switch to daily chart, and if you apply such very simple thing such as 2 moving averages with parameter first is 35 and a second let it be 150. Okay, that is daily chart. Every time market enters the area between fast and a slow moving average, you can search for a setup for entry to the short side. Here it is also, here it is as well, and the final setup was during October. Well, November also, market has also shown us that price had entered this area between 2 moving averages, but actually the slow moving average was violated in early December. So this market was not good anymore for short trade. Well, we had a new low, right? We had a new low in January, but it was not very easy to capture this trade. It was not very easy to capture this trade. So if you want to be a position trader, you would try to enter a short trade once price comes to this area between 2 moving averages and possibly capture 2 weeks or 3 weeks move that is going to last for 3 weeks. Maybe more, maybe less, I don't know. Also, let's watch the British pound. Well, what I'm showing you is just a technical application of position trading. So if you want to have an edge in position trading, first you have to identify the main trend. For example, let's again apply. Oh, sorry, I have applied envelopes here. It is not moving average. It is just an example. Don't pay too much attention to this example. It's just an example that I'm showing you just to visualize you the concept of position trading. Well, we may take 40 or 50, it doesn't matter. It doesn't matter, okay? So once market starts to break some kind of consolidation like it is shown here in November, what do we have here? We have pullbacks to the area between 2 moving averages, and if you think of yourself as a position trader, you want to get pullbacks and you want to trade pullbacks. These trades are already gone, I know. It doesn't mean that now we have a good opportunity on the British pound. I think that we don't have now a good opportunity on the British pound. It is just an example. So you want to search for an entry once price enters this area. Well, for example, you can switch to smaller time frames, and here are those areas on a 30-minute chart. You might, I don't know, you might build some kind of consolidation, even a triangle or so. You can even build some chart pattern. Well, why not? You can build some sort of a triangle and trade once price breaks the lower side of this triangle. You have a short position here. You have a pattern for a short entry, right? But the reason for the short entry here is the situation on a higher time frame. Because you see the setup on a daily chart, you combine it with the setup on a 30-minute chart or on an hourly chart, and you trade this setup. And when you are trade using the position trading style, you want to have greater magnitude than a frequency, because most of your attempts to enter a position can be unsuccessful. You get stopped. You may get stopped very quickly, right? Then eventually you will position yourself on the right side of the market and you will earn, I don't know, 20 to 1 profit loss ratio for your trade. I will show you again the example from my trading in January from Canadian dollar. I was trading in the beginning of this month. Let's again apply moving averages here. The Canadian dollar was pretty nice trending. It was a good trending market. Well, when you see very young trend or emerging trend, you might even see that market never touches the fast moving averages. It never touches the fast moving average. It's a very strong sign of the strong market. So here you even can see the triangle or consolidation. Market breaks out through this consolidation, and I enter the position on a smaller time frame, on 30-minute chart, and get this swing to the upside. If you measure previous move started from the previous extreme, you will get pretty much clear picture of where to take your profits. Okay, let's get back to our presentation. And what do you want to have trading, trend following, position trading? You want to have greater magnitude than a frequency. You might even have 10% of your trades being successful or being profitable. You will have very small stops, small losses, and big gains. And your performance will look like, I don't know, plus 10% for the month. For the next month you may lose 3%. Then for the third month you may gain, I don't know, 70% to your account. Then again you can do 0, then again you can take 25% on your account. If you combine all these numbers together, you will get possibly around 70% of profitability within a period of 5 months, which equals to 15% a month or so. So that is trend following position trading. You will never have any stability, and you will not treat the market as a source of monthly income. If you employ this strategy, you will never think of a market as a source of monthly income. What about the breakout momentum trading? To initiate a good breakout momentum trade, it is more short-term strategy, right? You will have to see support, and you will see the market breaking out from some kind of consolidation. What do I mean by support? When you see the market lean into the higher level of a consolidation, when volatility goes down, and when finally market comes to the higher border of this range, you may play a breakout momentum trade. You know very quickly whether you are right or not. So you can place a very tight stop, and you can limit your risk significantly. I will show you today's example from my trade on the gold. Let me show it on the chart. Market comes to an area of consolidation. Right, we see very good trending conditions here. Market comes to an area of consolidation. Volatility goes down, so you may see that previous day, Monday, was not very volatile. Market consolidates on the top. We have a trend on our side. Let's watch the daily chart, and you clearly see that you have a trend on your side. So you want to search for a breakout momentum trade, right? Well, maybe it is not the right timing. Market may not be ready to go in the direction of this trend for right now. When I see the setup here, when I see the market losing volatility and staying at the top, it is my setup for entry. I place a buy stop order, and market goes in my direction, so I have the opportunity to limit my risk very quickly. Let's switch to 15-minute chart, and you see how it works. That is my entry point, right? That is my entry point. Very small area of consolidation. That is my entry point. This is a level that market is breaking. It goes higher, and eventually, so I'm moving my stop close to break even. Very small risk, close to break even, and finally I am stopped out of my position, but I don't lose anything. I will try to capture the trade next time. Well, I have to have much patience when I trade in the momentum, when I trade in the breakouts. I have to have much patience, right? For example, when market emerges from consolidations like it is shown here, also you need to be near the monitor. That is your edge. If you have enough time to capture such setups, you need to be near the monitor. You need to be in the game. You need to be in the market. Pretty good momentum trade lasting for 2 days. Lasting for 2 days, or at least 1 day. You can also capture something within a day. Well, the market is already mature here, so breakouts are not very elongated. But if you see at the previous performance, if you see February, you will clearly see very good opportunities for breakout momentum trades. Market emerges from consolidation areas, and you see very good opportunities for momentum trades. Very small stop or very small risk, you can even re-enter several times before you enter a trade, and you just keep your position within a period of, I don't know, 3 to 4 days. That is an edge, right? You have a small stop, you have a greater magnitude, you have maybe frequency equal to 50 to 50 comparing profits with losses, 50% of probability on your side, but your magnitude is significantly greater. Well, most of breakout momentum traders, they like the gold market and crude oil market because they are very volatile, they are very directional, they allow to achieve very nice profit-loss ratio in their trades. Now let's get back to our presentation. Guys, do you follow my story? Maybe I am speaking too quickly, I don't know. So let me know if you understand everything that I'm talking about. So if you don't understand anything, you feel free to ask any questions in the chat. That is okay. I have raising hand. Well, I'm new to this webinar platform. I don't know where to see your question. Breakout is a nice strategy. Yes, that's why I like this strategy, because it allows really to achieve very good profit-loss ratios, and you know very quickly when you are not right. You know very quickly, and you just quickly get out of your position in a period of 2 hours. You drop your position, you cut your losses. But every trading strategy has its pros and cons. You have to be near the monitor. You have to be patient. Yes, in case you have a gap, it will not work because, yes, market just gaps beyond the level. Well, I agree with you. What about RSI breakout? Well, I'm not trading RSI. I'm trading the market. I'm trading currencies. Well, I understand what you're talking about, but I don't use it because for me, the main indicator or basic indicator is the price chart, is a price action. I don't follow any breakouts on indicators. Okay, how to identify support? Very good question. How to identify support? Let's first talk about this question, and then we will switch to the next question, which is what is the best time frame for breakout. First of all, about support. Let's talk about support. How to identify support? What is a support? Let's think of a support as a big market participant, big buyer, smart money buyer, slowly accumulating the asset for whatever purposes, but he doesn't want to move the market against himself. So he buys some at the beginning of the day, he absorbs some supply later in the day, he buys some more, he buys some more, he buys some more. Eventually he creates imbalance in the market, which has to be shown in a form of a breakout, right? When many traders keep losing positions, they eventually get out of their positions and they initiate a breakout. So the first sign of support is an elongation. You see elongated consolidation with a low volatility. That is a first observation. I call it right-handed skewing. When you see the market that is not correcting too much, it is going in a consolidation mode, and you can measure the angle between impulse and the correction, and it will be close to 90 degrees. It will be close to 90 degrees. So the more elongated correctional consolidation you will have, the better. It is right-handed skewing. And also support is better when it shows you the dynamic behavior rather than static. What do I mean by that? When you see that highs and lows are moving consistently in whatever direction, so it is better for your trade than in case you would see just the horizontal level. When market just gets back to some horizontal level, well, I would not call it a support. It is just the day trading game. Someone buys at this level, market goes higher. Someone buys again, market goes higher. It is not what big market participants do. If they need to accumulate an asset, they will do it in dynamic mode, or they want even to get lower prices. They will not use horizontal level. It is the sign of day trading activity. So they will even purchase at lower prices, but they will not do it in a horizontal mode. So the best support that we can see in the market is elongated correctional or consolidational move with the signs of decreased volatility, like we have seen it on the gold. That's what I'm talking about. That is correction, but at the same time this is a support. You see that if you measure the angle between impulse and the correction, you will have 90 degrees, and you see that the market loses volatility and it leans to the higher border of this range. It is a support, and we have seen, using volumes and open interest from the gold future market, we have seen that February 3rd has shown increase of open interest, substantial increase of open interest. So market has broken out from the range. So once you see the situation, you can play a breakout here. Well, you can also even try to get inside a trade here. You will get stopped. Then you might even get inside of trade here and here. You can try to enter the market 3 times. So you will have one stop loss, and then you will enter your position. You can even have 10 stop losses. It doesn't matter. Then you will have 20 to 1 profit loss ratio, and eventually you will cover your costs. So that is a support, right? That is a support. Well, what about now? What about current market? Is it supported or not? I would say that now elongation is not very big. If I see that the market continues to lean to the upper side of the range, it will possibly break. The market was trending, so the odds of breakout to the upside are greater here. So I will accept the trade every time market breaks the higher level of this consolidation. It is around 1273.80 or so. So every time market comes to this level, I will try to initiate a breakout momentum trade. Eventually I can get 5-to-1 profit loss ratio. Market is not, or trend is not very young here, so I'm not going to achieve 10-to-1 profit loss ratio. It is going to be a small swing trade lasting no more than 2 days. Unlike for February, where we had really good opportunities. Alright, so kindly show examples on the live chart about support and resistance, please. Okay, I'm showing it. Let's go once again. So currently gold market might be supported, but I want to see some kind of elongation. I want to see another day or one more day of the gold chart going in sideways direction. That's what I want to see, and I will say this time that it is a support. Well, as for other markets, markets now are sideways, so they are not going under any kind of support. They are sideways. Well, as for possibly British pound, maybe we might have something interesting here. Well, now it is generating higher highs and higher lows. It is the first sign of support. So if we see that the market consolidates here for some period of time, it will be a sign of support. You may say that this is a support. For right now, there are no very good examples of support in the present market. What is the difference between support and resistance? Well, support occurs when you have a buyer, and resistance occurs when you have a seller. It is the opposite situation, right? So it is the reverse chart. Chart goes down, and you have a supply pushing the market down. When you have a support, you have a demand pushing the market up. That is the difference. That is the typical example of the good breakout momentum trade. You see right-handed skewing. You can build an angle between impulse and correction and get it close to or more than 90 degrees. You have reduced volatility once market comes to the higher border of this range, and you have elongated correctional phase. So that is your trade location for entry. But again, you will have greater magnitude than a frequency. What about frequency? What if you want to get better frequency than a magnitude? I would say that you will have to employ strategies for the sideways market. It is firstly mean reversion, and secondly it is statistical arbitrage. Let's talk about mean reversion. If you want to scalp the market, if you want to take quick profits from the market, you want to capture small deviations from the average, small deviations from the mean. First of all, you have to identify where the average is, where the mean is, and you want to see that momentum is slowing down, and you will place opposite trade. You will place opposite trade with not very tight stop. You don't want to have very tight stop, and you capture small profit here. You capture small profit here. Let's go through on the chart on a trading terminal. I will show you a couple of examples. Well, for example, what can be better used for that purpose? I would say that you may use indicator called envelopes or Bollinger Bands. Let's remove moving averages from here. Let's take, for example, British pound and apply envelopes here. with a period of 35 and with a deviation of 37, it will be okay. What is an envelopes? We were talking about this indicator in the previous webinar, which was called indicator-based trading. So you have an idea of an average or a mean built by a moving average, right? And then you measure deviations from this moving average. This is a 30-minute chart. You may use the smaller time frame if you like. Once market gets away from average or from the mean, you want to measure, or you want to see that momentum is slowing down. Momentum is slowing down. How to see that momentum is slowing down? You see that the volatility goes down. You see the ATR goes down, the volatility goes down, right? Momentum is slowing down. That's the way it works. You place a short trade, you place a stop, and you place a take profit. It is equal to 1-to-1 profit-loss ratio. You may even try to place a buy stop order once market reverses above envelopes and enters this channel or trading range. You capture a small profit. You see, profits are really small. They are not so big, but they can be consistent. For example, if you employ 15-minute chart and you use smaller parameters of the envelopes, for example, you take 12 periods equal to 12, and the smaller deviations, you can capture, when the market is range bound, when the market is sideways, you can capture smaller profits here. You see the market breaks out through the upper band of the envelopes. Once it gets back, you capture small profit. It breaks out, or well, here it is not breaking out, it just touches this level. It breaks out, it gets back, you capture a small profit. It gets out, it gets back, you capture a small profit. It gets out, again you capture a small profit. That's your trade locations. You know, you can achieve 70 to 80% of probability following this strategy, but in case that the market is not trending, once market becomes trending, it becomes very difficult to capture anything, right? Because market just goes and goes and never gives you any profit here. So you also have to have very good understanding of market condition on the other time frame. You will need to say, okay, this market is breaking out for right now, I will not go against this market. Or at least you will try to go with the trend, capturing small deviations, right? Well, you need to generate enough flow, enough quantity of trades to get your performance going forward. Well, for example, this time market is pretty volatile. Well, if you want to capture something on the British pound, you will need to let it break out through this lower band of the envelopes. Let it break out, let it get back, and you capture a quick profit here. That's the way it works. That is sideways action. That is a strategy. That is a very short-term strategy, right? But please note that your profits are pretty small. You put a hard work and you achieve modest result. Your equity curve goes slowly and slowly. It goes slowly up. You also have drawdowns, and you are getting away from these drawdowns. Well, it's a hard work. So it's up to you to decide what kind of strategy to use, what kind of edge to employ. Also, you can employ counter-trend strategies that are similar to breakout momentum strategies, but they are employing the opposite principle. You follow the level, you don't go with the breakout, you wait for the market to get back to reverse, and you you get back, you enter a short trade and try to take the trade with a profit-loss ratio more than 1-to-1. But it works better when you fade overbought or oversold market condition. Well, what does it look like? It looks like when you see 3-to-4 or 3-to-5 area of accumulation, when market goes higher, higher and higher, and eventually it consolidates on the top. It can break the upper extreme. It consolidates on the top, and finally you go against this market. You see the liquidation. Why we didn't get any presentation notes of older webinar after that? I mean that you haven't got any presentation on email. Well, guys, I would say that if you want to get a presentation, you will have to email me directly, and I will send it to you. I don't know why you haven't got this presentation. I asked to do that, I asked organizers to do that. Alright, let's get back to the next question. Which is the best strategy you use mostly for faster profit from the market with a low risk in the intraday market? It is breakout momentum strategy and counter trend strategy, trading false breakouts. When I want to get a quick profit, I most of the time trade counter trend. I trade false breakouts because false breakouts are more frequent than really good breakouts. But I know that I don't need only to have quick profits. I also have to have big profits to have my account growing. How would RSI would be used to identify oversold, overbought? Well, I don't use RSI to identify overbought, oversold. To identify overbought, oversold, I use a couple of observations on the price chart. For example, I will show you a couple of observations. Once market fails to achieve previous high or previous low, in this case it is previous high, it is sign of weakness. So possibly all this movement that was preceded to this action was not a smart money buyer. It was possibly weaker handed traders. So I can go against this trade. If market fails to achieve high, I can go against this trade. That is the first observation. The second observation is when market loses volatility, when it fails to break the level, it loses volatility, it consolidates around some level. Well, the best example was, I believe, on the British pound. Just a minute. That's the way it worked. Here, market was consolidating around the top, so it has corrected. It consolidated around the top, and all attempts to achieve high, the highest point, were unsuccessful. It means that possibly the market has become overbought because somebody was buying here. Some traders were buying here. They were buying at these points, but eventually they were unable to generate any meaningful move. Also note that you have a horizontal level. It is a sign of intraday activity. It's not big players involved. It's not big time frames involved in the game. So if you see that market consistently fails to achieve previous extreme, it is a sign of possibly weaker handed traders involved in the game. Market becomes overbought. You can go against this market. Well, you want to get inside of trade, you want to get against correctional move. You want to trade against correctional move. It is better when you trade in the direction of the main trend, but against the correctional trend. For example, you have extreme here, market leans to this extreme but never touches it, fails to touch this extreme. That is your opportunity. That is your opportunity, because you may see liquidation to the downside. That is a very good opportunity because it helps you to achieve quick profit with good magnitude and achieve better profit-loss ratio than for the majority of other strategies. Alright guys, now we are coming to the finish of our webinar, and I want to ask you a question. That is not for the answer. Just try to answer this question to yourselves. What type of trading are you comfortable with? Trading is not about doing right things, doing 1, 2, 3, 4, 5. No, every trader is unique, every trade is individual. Success cannot be reproduced and cannot be simply copied. So answer this question to yourself. What type of trading are you comfortable with? It is not a quick profit that you need to get from the market. You need to be with trading for some elongated period of time. Maybe you will need to trade for 1 or 2 or 3 years, and you will need to survive within this period, not to get out of the game. You will need to survive and to build your account. And to be able to do that, you will need to find some strategy that you are comfortable with and to stick to this strategy. Not searching for quick profits, but focusing on just executing upon your trading plan. It's more like sports. The pictures that you see here are taken from sports, right? Trade is like an athlete. He needs to show incredible performance and also to improve consistently, improve his trading, and stick to some kind of trading plan, to be disciplined. So what type of trading are you comfortable with? Let's go once again through possible strategies or possible approaches. You may want to be a trend following trader with more rare trades, with less frequent trades, and with more magnitude on a side than a frequency. You may want to be a breakout momentum trader. It requires a lot of patience, really a lot of patience. But if you apply this strategy, your results might be very, very good. Or you may be a trend following swing trader if you don't have enough time to sit near the monitor all day. You might want to be a counter trend trader, trading false breakouts, fading overbought, oversold market conditions. Or you may want to be a mean reversion trader, short-term trader, be a scalper, employing very short-term opportunities and trying to get more frequency on your side than a magnitude. So that's the way to go. Every strategy, every trading approach is good when it generates profit. Well, with that we are going to finish our webinar. Thank you for coming. Thank you for your questions. Thank you for your interest. We will have another webinar this month. I guess it will be in 2 weeks or so. So please follow emails. And if you want to get the presentation, please send me a direct email. I will leave my email right here. In a chat. I don't know whether you see my message or not. This is my email that you might want to right to get a presentation. All right. So thank you. I hope that this webinar was useful for you, that some of these ideas that you heard within this webinar you will use in your trading. Please remember that there are no shortcuts, there are no easy answers. So if you have any ideas, please test them using simulator or historical backtest before putting real money at risk. With that, we are finishing. Thank you for coming. Thank you for listening. Thank you for your attention. See you on next webinars.